Some of you remember this. For many of you, this is all something in the past. This is how the stock market used to operate in the past. And this is how we had the 1987 crash and the 1997 crash. And those crashes were mainly driven by this number of people who are trading manual trades and a lot of chaos that happens in the stock market after a sell-off. 1997 was the last crash, and in 2007 we skipped a crash, but we had a recession right after. 2017, we did not see a crash, and that is because we put a lot of systems and a lot of neural networks were now put in charge of actually making sure a crash does not happen. Also because the fact that people stopped getting involved. So just like people shouldn't be on the road driving, people shouldn't be out in the stock market trading stocks because people make mistakes and people are emotional. The current stock market today looks like this. This is how the trading floor is. All that chaos is gone. And what is interesting that about 10% of trades are done by humans today only. And that's also done in an electronic fashion. 60% of all assets on the stock market are traded by and controlled by algorithmic trading. And that basically is split between rule-based and machine learning-based trading that is driving most of the decisions in the buy and sell on the stock market. That number has doubled since 2010. Today's market is largely transactional. It's largely driven by short-term transactions that are driving fast turnaround and fast profits for the traders. Why is all that happening? Why did that happen? Well, it turned out, you guys and ladies, you are a lot cheaper than stock traders. Or maybe some of you are, or maybe the bulk of them are a lot more expensive than one of you guys. So in 2017, Goldman Sachs actually laid off 600 of their traders and hired 200 data scientists instead. And the reason for that, they thought, was, well, we're going to save a lot of money. Well, that's obvious when you actually build one system and use that system to copy and paste for multiple tradings and multiple transactions and multiple clients. You don't have to hire so many traders. You could run that with a machine learning bot that actually make predictions and build portfolios for your clients. It's also a lot more stable, you know. Obviously, machine learning and computers are a lot more stable, more predictable, and less subjective. They're not influenced by emotions or other elements. And it's a lot more scalable that can be offered to different customers in different areas. It also afforded them the secrecy or hiding the data or hiding the processes or hiding the elements of decision making from anybody, including their own internal employees. We're Manceps, and we help our customers build AI solutions and provide ML, production-grade ML in the enterprise. The reason why we got here, the way we got into doing this research is by engaging with our customers in a lot of audits and a lot of engagements where we help our customers not only fine-tune for performance and for scalability, we help our customers audit their neural networks. And in auditing their neural networks, it was very obvious that adversarial attacks are the key element that neural networks are susceptible to. And this is where we started researching. So what an adversary could potentially have, what someone who's got malicious intentions to either wreak havoc in the markets or drive some profit or drive someone bankrupt. So this is how we got started. And Garett is going to continue describing how it's done and how did we build this lab that you're about to see.
Thank you. Is my volume okay? Hello, TF World. Thank you all very much for coming here. I realize there's a lot of other really good sessions going on right now, so I congratulate you all on having great taste. As Al was talking about, the market has changed drastically. It is now run mostly by automated trading. And we sought to recreate some of that in a closed, controlled experiment. Part of what allows that trading to occur is that bots are capable, or neural networks are capable of picking up on really, really subtle, imperceptible patterns, the fun, invisible world of conditional probability. If this stock has moved this amount in this couple of days, and this other stock has moved this, and this volume has moved this, and this is the day of the month, then given those, we are most likely to see this change. So for our experiment, we took some historical data from a random sample of companies unrelated to the convention, Intel, Amazon, AMD, Microsoft. We took 20 years of data, so sorry, Google, you guys didn't have 20 years. And we took their high, their low, their open, their volume, and we took the adjusted close as the target for prediction because we wanted to allow the bots to learn a little bit of seasonality if they could, and that would have a little more explainable variance than the close itself, which would sort of jump around based on how those adjustments came in. Scaled them by 10H estimators, by year, by company, and by company year, and fed all of that data into a series of bots. So we did just a random grid search on hyperparameters, not really trying to get to an optimal hyperparameter, but just trying to set an environment of different bots that would behave differently and make different predictions given different inputs. If any of you went to our lab yesterday, the network for these bots is pretty similar to that one. It's just a set of 1D convolutional layers with a dense pooling coming out of them, and merging dense layer, and then a prediction of the same length as the number of companies in the data set. And you're just trying to minimize the mean squared error loss between those prices and the actual prices. And of course, that experiment worked fine. It's not too difficult to get something fairly close to that and keep validation loss under control. But what was much more interesting is the question of if these bots really are better than human traders, or if some of their strengths are also some of their weaknesses. So yes, bots are great at pattern recognition, but their type of pattern recognition is also a pattern, and that can be recognized by another neural network. So we created an environment where we took those bots, imported them in to the graph of another neural network, frozen, untrainable, no access to any of its layers. And we allowed this bot, we wanted the hypothesis, or the idea behind the experiment is that this bot is just someone else buying and selling commodities in this closed market. And it's allowed to make slight changes to the amount of volume. It can't control the price, it can't control the day, it can't do anything to any features other than have the volume reflect its own activity. And unlike those bots that were trained on trying to minimize their MSE loss, this one is trying to maximize the loss of those other bots based purely on the way it decides to adjust volumes or how much it decides to buy and sell. So fairly straightforward, I think. We'll see. So go into a demo of how that, after we trained that bot, I'm going to show you how in our closed system, that bot was able to make small changes to the prices of those companies, and how the total holdings of those other bots, or those bots are kind of being represented as classes that have holdings, and each one of them is tied to one of the networks that was trained to predict price. And based on the percent price difference expected between the current and the prediction, they decide to buy or sell individual stocks. The caveats to this are, it is a closed system. The bots and the adversary only are subject to one price. There's no gap between the put and the call. So whatever they buy for is also what they sell for, and there are no transaction fees. This allows things to make money in an experiment like this that would not necessarily work in the real stock market. The data is also limited to just this time series data. So in a sense, these are just very intelligent chartists. They don't have access to NLP of press releases or Twitter or fundamental analysis, any of that would go into a real trading bot that's probably in production right now. So now I'm going to switch the display, and hopefully this works. I've tested this about 30 times, so I can assure you this is the time it will fail. All right, it's supposed to wait a few seconds. It's not broken. It's just so I can shift this around a little bit. All right, now it's moving. Okay, so what we're going to see here is the market prices for those 8 companies we selected. The bots, this happened very quickly within the first couple of iterations. Some of them severely lost their holdings. Others are doing fine and continuing to make money. This is the small micro adjustments the adversary is making. Because volumes are on huge scales and vary by company, I decided to just display the scaled adjustments because it would be sort of easier to see. Because they're 10H estimator scaled, most values are going to be between like right around 0.5. So the fact that these are changing by 0.0001 indicates that it's barely doing anything. And the adversary is making holdings over the course of this. But the really interesting and exciting part of this is not just that it worked and was able to cause some of these bots to lose money, but that when it decided to traverse the loss space of how it was going to do that, it didn't affect all of the bots. It realized there were some that were easier to fool than others, or some that had more predictable pattern recognition in terms of how its volume changes would affect them. And those are the only ones it really learned around while minimizing its loss. So you can see other bots have gained money, and 1, 4, and 6, or 2, 5, and 7 have significantly lost it, which is kind of cool. I think the demo this is like about a year and a half worth, and it's probably almost done, but I think we can switch back because nothing new and exciting is going to happen in there. Did it work? Yeah, it worked. All right, so the conclusions we get from this are bots are smarter than human traders, and bot traders are dumber than human traders. These minor little changes to the volume of trade activity for these stocks would not affect a human trader knowing that Amazon sold an extra, someone bought or sold an extra 1,000 Amazon shares today out of the entire stock market. But when these bots see 1,000 Amazon shares go up and 5 Microsoft shares sold and 30 Intel shares, it decides that's some special combination that signals the price is going to change one way or another. But at the same time, bots are smarter because they are also able, as you saw with the other ones, they were able to, given our closed controlled experiment, continuously accrue money on their predictions. And I think that's...
Thank you, Garett.
Yeah.
So, like Garett described, with adjusting just a little bit, introducing some well-calculated transactions in the stock market, in very low volumes that would cost an adversary very little money, we're able to make a significant change to our holdings and to other bots that are running the market's holdings. This concept was demonstrated on computer vision with multiple adversarial attacks where a stop sign can be read as a go sign if a few pixels were changed, and that allows the network to see different than what the human eye would see. And by changing just one pixel in some cases, you're able to completely change that prediction if you change the right pixel to the right tone. We applied the same logic, the same concept to the market, and guess what? This could be used for by a malicious person to introduce some new dynamics in the market. We are doing this to raise awareness. We're hoping that this will allow all of us to work together on improving those neural networks, on building networks that are robust for those kinds of attacks, that we are starting a movement that will allow us to put our hands together and really getting the technology to be robust enough to be more sustainable and manage the markets in better ways. We ask that you join us either by coming out to our booth today and test out the lab if you haven't yet, and try to change some parameters to what your human intuition will tell you would be ideal, and run the training and the prediction. And the closest prediction is going to win a prize by closing bell today. And we're working with real-time data. So you're going to be training with yesterday's data, so you have the same shots like everyone who did the lab yesterday. Also, please scan that barcode or that QR code and go to our GitHub repo. And we are open sourcing the whole project today. So all the code and all the bots, the lab, and the adversaries are in GitHub. And we ask that you please use it wisely. Don't get us in trouble, please. We don't want to be in trouble with the SEC or anyone else. But we ask that if you find ways to help better the code or optimize it or make suggestions, we welcome pull requests, and this is a community project. And if you're out here looking for a job, we're hiring. Oh, just my plug, sorry. So with that, I want to thank the TensorFlow World and the entire community and O'Reilly for hosting us, and we're happy to answer questions. And if you don't mind rating our session after you leave this.
Thank you.
Any questions for the lab or for the?
Is this approach extendable to other products which are not necessarily traded as frequently, or is there an inherent assumption in your model which assumes that it has to be frequently traded or with a certain frequency?
I mean, this approach is extendable to anything else you're training, really. I mean, anything where you have a loss that you have mapped and are minimizing and can create a scenario where you're able to block another network that's learning off of pre-trained networks from kind of getting more information than it should have. But anything where you can combine them in a graph like this, you could apply the same approach to. I don't think there's anything super special about the stock market data. I think it's effective for this particular problem just because the fluctuations are pretty mild, and it's easy to create a bad prediction, especially when you're limiting the feature space like this, just by making small adjustments.
Let me add one more thing. Any time series data is good for this kind of a prediction. In fact, we tried this on predicting the weather. So we trained a network with the 2010 weather information, and we attempted to predict tomorrow's weather with it, and it was more accurate than the weatherman. Without any knowledge of anything weather related. So I didn't go to college for 4 years and didn't study weather at all. But if you try an adversarial attack on the weather, it's not going to rain tomorrow, I promise you. Any other questions?
Unless you're in Portland, and then it's going to rain tomorrow.
So I can envision the case of, can it discover the case of where even there's collusion between even traders, for example, say insider trading, they have some specialized inside information and they're concocting suspicious trades, right?
You could, I mean, there are cases like, that's actually, sounds like a cool, interesting use case. I mean, for something like that to work, you would kind of have to have access to the algorithm two different firms are using through some API.
Not necessarily. I mean, just from outside information, say, if I were the SEC and I was trying to catch a bad actors within the system, say for example.
Sure, yeah. So I don't mean full access to the network a trading firm is using, but in this scenario, for instance, if you were able to run inference on their network somehow through whatever, seeing if somehow if it's not responding to minor changes the way it normally would, then you might have a signal of insider trade, or they might have just trained it more robustly than our demo bots.
Right, and another application possibly could be if, say, you're looking at other financial networks like Swift, say, for example, and looking at financial transactions and looking at transactions that may indicate that some kind of money laundering is going on, say, for example.
I actually would love to have this conversation with you outside. This is amazing. I think that's great brainstorming, and I think those would be great ideas to put together, because we have the data, we have the networks, and just adding those components to it is somewhat trivial.
Yeah,
you just add features.
The reason why I'm saying this is because I'm not sure the SEC can keep up with the technology and their ability to actually enforce regulations is being stifled by that, I think.
Absolutely, and I think we in the private sector have the obligation to help out and point these issues out so they don't become problems. We don't want to wait for such things to evolve as viruses or worms have evolved in the past. Yeah. Any other questions? I saw someone's hand up somewhere here. Well, I want to thank you so much for joining us today, and please do visit our booth and try the lab if you like. It's a 10-minute thing that's gonna show you how neural networks work. Even if you're not technical, all you're doing is pressing run on cells. If you didn't make any modifications, you're just gonna get the same guess like everyone else. Maybe changing some hyperparameters or the structure of the network could help you gain an edge, and that will give you exposure as to how these things work. And as I said, please look up the GitHub repo and feel free to add or make suggestions. Any pull requests will be absolutely welcome. Thank you all very much for coming out today.
Thanks, guys.